Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. The S&P 500 has suffered a swift and severe downturn in recent weeks, plunging 10% from its recent record high in just under a month. This rapid decline has erased approximately $5.28 trillion in market value. The market turbulence comes amid escalating trade tensions under US President Donald Trump's administration, with tariffs against major trading partners fueling investor uncertainty. Concerns over economic growth, declining consumer sentiment, and cautious outlooks from major retailers such as Walmart have only exacerbated market jitters. Barclays strategist Emmanuel Cao noted a shift in investor sentiment, describing an, quote, uncertainty tax, end quote, that has begun to weigh heavily on growth expectations. A key driver of the sell-off has been the unwinding of artificial intelligence trade, which had propelled major technology stocks to unprecedented highs. Since mid-February, Nvidia has tumbled 17%, while the Round Hill Magnificent 7 ETF, MAGS, has fallen 16%, with the S&P 500 still trading at 24.1 times its trailing 12-month earnings, well above its historical average. Concerns about overvaluation persist. Unlike previous downturns, US government bonds have not provided a significant safety net. Historically, bonds rally when stocks decline as investors seek safer assets. However, the 10-year US Treasury yield remains relatively stable, indicating that the current market turbulence is being driven by sentiment rather than fundamental economic weakness. Despite wobbly data, the US economy has not deteriorated as dramatically as market movements might suggest. Adding to the old adage that there is a difference between Wall Street and Main Street, investor confidence appears to have been shaken somewhat by what some have called erratic policy shifts from the Trump administration. Trump's trade war rhetoric and threats of tariffs against Mexico and Canada have introduced fresh instability. While defenders of the administration say that this is part of a medium to long-term plan which will ultimately benefit the country and its economy, in the short term at least, investors and markets are moving into safer assets. While some investors hope for Federal Reserve intervention, the central bank has signaled no immediate plans to cut interest rates, with the Treasury Secretary downplaying the stock market volatility, emphasizing long-term benefits over short-term pain. Despite the turmoil, some investors believe that US stocks could eventually attract bargain hunters. However, with the S&P 500's price-to-earnings ratio still elevated at 24 times, the market may have further to fall before stability returns. For now, fund managers remain wary, and the road ahead remains fraught with uncertainty. Next up, we move across the Atlantic. In the first week of March, US President Donald Trump paused all US military aid to Ukraine. This move was apparently triggered by a heated exchange a few days earlier in the Oval Office. Within a few days of this action, European Union leaders committed to rearm Europe by mobilizing 800 billion euros in defense spending. Now, as European nations commit to ramping up defense spending, economist Ethan Ildzitsky from the London School of Economics in a recent report believes that increased military expenditure could yield broader productivity gains across European economies. In his recent literature review, Guns and Growth, Ildzitsky argues, quote, a transient 1% of GDP increase in military spending could increase long-term productivity by 0.25%. End quote. His argument is twofold. First, defense-related research can drive technological advancements with civilian applications. Second, expanding military production encourages, quote, learning by doing, end quote, a process that enhances efficiency and spills over into other sectors. This is a phrase that was coined during the Second World War. The potential productivity boost is encouraging for Europe, which has pledged hundreds of billions of euros in new defense spending over the coming years. However, to maximize the economic benefits, changes in procurement strategies are necessary, starting with reducing dependency on foreign suppliers. US-based Bloomberg Economics in a recent note observed, quote, right now, the main impediment to defense spending buoying the economy is the fact that about 80% of military hardware comes from outside the EU, and much of that from the United States. End quote. European defence stocks have surged recently, signalling market confidence in increased domestic procurement, though substantial shifts may take time. Ilzetsky also advocates for spreading procurement across smaller companies and centralising efforts within the EU. Quote, "It makes no sense for every EU country to have its own domestic procurement strategy," end quote, he argues. One potential solution is adopting the US model of dual sourcing, ensuring key military products are supplied by at least two member nations. Additionally, Germany may need to reconsider its restrictions on university involvement in military research. However, the benefits of defence spending hinge on what it displaces. Moreover, historical analyses suggest that while World War II initially spurred US industrial growth, the military buildup ultimately detracted from domestic infrastructure investment. Recognizing these trade-offs, the EU has acknowledged the importance of dual-use R&D, technology with both military and civilian applications. A 2024 white paper underscored the significance of leveraging defense investments for broader economic benefits. Ultimately, while increased defense spending could enhance European productivity, the inverse is also true. Economic strength underpins military power. Quote, "A long line of research finds that wars are ultimately won by the country with deeper pockets," end quote, he notes. Whether through defense spending or broader economic reforms, Europe's security will depend on its ability to remain competitive in an evolving global landscape. Next up, we move to Asia. If you're getting some value from today's episode of Market Update, don't forget to hit the like button and maybe consider subscribing. The latest round of 25% tariffs imposed by US President Donald Trump on steel and aluminium imports has sparked a range of reactions across Asia, from disappointment and regret to defiance and strategic maneuvering. While countries like Australia, Japan, and South Korea sought exemptions, the White House firmly denied any carve-outs, reinforcing its America First trade stance. Australian Prime Minister Albanese expressed disappointment over the tariffs, calling them contrary to the spirit of the two countries' close ties. Despite initial optimism following a conversation with Trump in February, Canberra ultimately failed to secure an exemption. However, with steel and aluminium exports to the United States accounting for less than 0.2% of Australia's total exports, the direct economic impact is expected to be minimal. The government remains committed to negotiating a resolution, drawing on past diplomatic successes under Trump's previous administration. Japan has also lamented the lack of an exemption, with Chief Cabinet Secretary Yoshimasa Hayashi warning that the broad trade restrictions could negatively impact Japan-US economic relations and the global trading system. Meanwhile, South Korea's Trade Ministry swiftly convened an emergency meeting emphasizing efforts to mitigate disadvantages for its industries. A high-ranking official was dispatched to Washington in an attempt to stabilize business conditions for South Korean companies. South Korea is facing additional trade pressures, including potential tariffs on automobiles and the uncertain future of the CHIPS Act, which was originally designed to incentivize semiconductor investments. The looming 25% tariffs on imported cars could compel South Korean automakers like Hyundai to ramp up US-based production to circumvent the financial burden. Hyundai has already begun expanding its facilities in Alabama and Georgia, demonstrating a preemptive response to Trump's protectionist policies. Of course, China has doubled down, and we're moving into what will likely be a US-China trade war 2.0, but we will not discuss that here. On my channel China Update, we have discussed this in great detail and will continue to follow it closely. India, though not directly targeted by the tariffs, is expected to feel the ripple effects. With Japan, South Korea and China facing reduced access to the US market, they may divert excess steel production to India, exerting further downward pressure on domestic steel prices. In response, India is considering safeguard duties of 15 to 25% on imports to protect its local steel industry, mirroring a similar move from 2015. The tariffs mark yet another chapter in the shifting global trade landscape, highlighting the challenges US allies face in negotiating with an administration during a period of greater protectionism. And of course, non-allies like China will likely have an even harder time. As Asia navigates these changes, governments and industries alike must adapt to new trade realities, balancing diplomatic efforts with strategic adjustments to protect their economies. Okay, that is today's episode of Market Update. Thank you very much, everybody, for watching. If you enjoyed the episode, don't forget to like and subscribe, and I will see you later in the week for another episode.